there, I'm Jeremy Drolbeck coming to you from FirstClassMortgageService.com. So you want to know how much you can afford. I always tell people we don't approve you so much for a price as we approve you for a payment. And we take that payment number and we say, all right, well, here's how much house, that equates to. So how do we figure out what your maximum payment is? First off, it's a little more involved than what I'm going to tell you here, but this is the real basic formula. And I will say there's definitely exceptions to this, and loan programs vary, and everybody's in a little bit different boat, but this will get you there for a general rule of thumb, and it's a little more conservative of a number. So you're going to take the magic number being 41% of whatever your income is. So let's just say your income here is $3,000 a month. 41% of that equates to, help me out here, $1,230, correct. All right, so that would be the max you can have going out each month for your housing payment and everything, all the minimum payments that are on your credit report. So let's say you have an auto loan that's $230 a month and a credit card that is $100 a month. So you have $330 going out each month. We're going to take the $1,230 minus the $300, and that takes us to $900 a month, correct? That would be the max you could have for a house payment. That's your principal and interest portion of the loan, homeowner's insurance, PMI if there is any, and property taxes would not be able to, in that example, exceed $900 a month. So $900 a month, we then take that and figure out how much house you can afford. That's going to give you a $900 payment. Again, there's exceptions to that, but that's the general rule of thumb. Self-employed people, this is where it gets complicated because, it's easy to figure out an hourly person's income. They make X amount of dollars and that per hour, and they work so many hours a week, and that equates to, whatever it is. Self-employed people, be very careful. I talk to a lot of self-employed people that think that they had $100,000 worth of sales and they make $100,000. That's not what lenders look at. What lenders look at is the bottom line, the net profit. How much did you pay taxes on? How much did you tell the IRS you ended up walking away with? So you're going to have in most self-employed cases, and again, this gets complicated with the different tax returns that are filed and things, but generally speaking, you'll see your self-employed people filling out a Schedule C. We take that net, or that gross income is going to be on the Schedule C, and then they're going to have all these different write-offs there, where they write off mileage or marketing expenses, phone expenses, office expenses, whatever, and that you end up with a bottom line net profit number of, say, $30,000 because you had $70,000 in expenses on that $100,000 worth of income. Well, that $30,000 number is what we're going to use. We're going to actually take the last 2 years and average those. So if it was 31 year and 5,000 the next, you're going to end up with a lower number for sure. So self-employed people, definitely call us, send us your tax returns. We can figure out the nitty-gritty on it. But that's what you want to watch. If you write everything off and show a loss, guess what? You don't have any income. You're not getting a loan. That's all there is to it. Right? So you've got to show some income there. It doesn't necessarily have to be a lot, but the more income you show, the more you're going to qualify for. And again, we can help you figure this out. There's certain things we can add back into, like depreciation. So the best thing to do is talk to an expert, such as myself, and you can do that here by finding me on my website, FirstClassMortgageService.com. Until next time.